My name's Ethan Braid. Today we're going to talk about why you are not beating the S&P 500 with your investments. There are three primary reasons that most investors fail to beat the S&P 500 over a long period of time. The first reason is that you are too diversified with your investments. If you have asset classes like bonds, commodities, real estate, emerging markets debt, and things like that in your portfolio, you cannot possibly expect to beat the S&P 500 over a long period of time. And the reason is simple. Some of those asset classes, once you get too diversified, are going to act like an anchor on your returns. They're going to hold you back. You diversify to protect your money, but not to grow it at a rate greater than the returns of the stock market. Here's a simple example. This graph shows the total return for a $10,000 investment in the S&P 500 versus the aggregate bond market for the last 21 years. The S&P 500 is the orange line. We're using the ETF SPY as our proxy for the S&P 500. Had you put $10,000 in the S&P 500 21 years ago, September of 2003, today you'd have over $80,000. Conversely, if you had put $10,000 into the AGG ETF, which is the aggregate bond market, today you would have $19,000. Huge difference. Over time, you cannot expect bonds to return as much as stocks. Therefore, if you have bonds in your portfolio, you're never going to beat the S&P 500 over a long period of time. Now, you might get lucky and beat the S&P 500 in any random year with a diversified portfolio, but if you're planning to hold for 10 years or longer, your odds of beating the S&P 500 with a diversified portfolio are very low. And if you're going to hold for 15 years or longer, your odds are at about zero. So understand that if you have diversified assets in your portfolio, like bonds, like commodities, like real estate, etc., it is very irrational to expect to beat the S&P 500 if you're going to hold for a long period of time. Now, I've been a financial advisor for over 25 years. I've met with over 300 wealthy families throughout my career. The information that I'm sharing with you is based upon my own empirical data, my own observations. And I can tell you definitively that I can't count the number of times I've met with people, wealthy investors, who are confused and don't understand why they're not beating the S&P 500 when they have a diversified portfolio. And it's one of the reasons that I'm making this video for all of you out there to watch it and hopefully to learn that you cannot expect to beat the S&P 500 if you have 20 or 30% of your money in the bond market. Again, maybe in a random year it could happen, but over a long period of time, it's not going to happen. And that leads us to point number 2 of why you are not beating the S&P 500. You are not taking enough risk. If you have an account with a robo-advisor or one of the very large brokerage firms or investment management firms, then you've probably answered a risk profile questionnaire. And on that questionnaire, there's going to be a scoring system, quantitative and qualitative. And one of the questions will be something like 1 to 10, 1 being the most conservative, 10 being the most aggressive. How do you feel about risk? The moment that you answer anything less than 10, you're going to be allocated fixed income in your portfolio, thereby virtually guaranteeing that you will not beat the S&P 500 if you're going to hold for 10 years or longer. It's just not going to happen. So you need to make sure that your risk tolerance is consistent with your goal of trying to beat the S&P 500. And here again, I've met with over 300 families in my career to talk about their finances, and it amazes me how many people tell me, I want to beat the S&P 500. And then on a 1 to 10 scale, how risky are they? I'm a 5. It's just not going to happen. It's irrational to expect to beat the stock market if you're too diversified and taking less risk than the stock market. How can you expect to beat the S&P 500? And yet, many people think that they're going to beat the S&P 500 or have an ambition to beat the S&P 500 when they're overly diversified and they are not taking enough risk. As a final note on risk taking being the reason why you are not beating the S&P 500, I've only met a handful of investors throughout my career who are willing to take enough risk to beat the S&P 500 over a long period of time. At the same time, I've met dozens and dozens and dozens of investors who want to beat the S&P 500. They expect to beat the S&P 500, but they are absolutely unwilling to take enough risk to beat the S&P 500. Big disconnect there. The S&P 500 can be a wild ride during recessionary periods like we had in 2001, minus 49%, and 2008, minus 56%. If your goal is to beat the S&P 500 over time, then you're going to take more risk than the stock market as a whole. You should expect greater volatility, and on the downside, you have to be prepared to lose even more than what the S&P 500 loses if you want to beat the market over a long period of time. So while most investors expect to beat the S&P 500, they simply cannot handle the risk and volatility necessary to beat the S&P 500 for a long hold period. The third reason why you are not beating the S&P 500 is that you trade too much. If you are in and out of the market based on the most recent bad headline or some news that you read about the economy, then you can pretty much forget beating the stock market over a long period of time. I'll make this really simple. The number one investor in the world, Warren Buffett, when asked what his favorite time is or when his favorite time is to sell a stock, his answer, never. In other words, he plans to hold as a perpetuity the investments that he makes. He's looking to hold indefinitely, and you should too. That should be your mindset. If you want to beat the S&P 500, then you need to be prepared to hold through really, really rocky periods. That is how you're going to compound your wealth over a long period of time, possibly at a rate greater than the S&P 500. Warren Buffett's been down around 50% and more at least 8 or 9 times in the history of Berkshire Hathaway. So you don't get to beat the S&P 500 without being willing to accept risk and volatility. So let's sum it all up. There are 3 primary reasons why you are not beating the S&P 500. You're too diversified, you don't take enough risk, and you trade too much. If you're in any one of those 3 categories, or possibly all 3, then you have no chance of beating the S&P 500 over a long period of time. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.